Hello, everyone, and welcome back to our weekly session. I'm your speaker for today's webinar. My name is Jean Setera, and together with me is Miss Sultana. She's one of our compliance auditor, and also Mr. Ejaz Alam, a director and managing partner here in AMCA. So, for all the joiners in this webinar, I would like to give a brief introduction of our company. So we are from AMCA, Abdullah Al Marzuki Chartered Accountants, an auditing firm with a decade-long experience. We are also registered in the Ministry of Economy to operate as a licensed auditor as well as tax agent from Federal Tax Authority. On our previous webinar, we talked about corporate tax deductions. So for today's topic, we will discuss the transfer pricing and its impact on businesses. The highlight of this topic will focus on related parties and control, payments to connected persons, arm length principle, and the documentation. So, without ado, let's start the discussion. So, as I mentioned, our webinar pointers for today is regarding related parties and control, payments to connected persons, arm length principle, and the documentation. So let's start for the definition of the related parties. So a related party is an individual or juridical person that has pre-existing relationship with another person through ownership, control, or kinship in the case of natural persons. With respect to ownership and control, it is internationally common to set the related party ownership threshold at 50% or more, on the basis that a simple majority is typically sufficient to exert influence and direction over the another entity. So when we say the related parties, there are the scenarios how we can identify. So first one, a natural person and a juridical person were a natural person or one or more person-related parties of the natural person are shareholder in the juridical person. So as we see in this example, there's a person A who owns the 50% shares in company. So so we can consider them as a related party because he owns the 50%. 50% is the minimum. Okay, we're in the scenario number two, the natural person alone or together with the related juridical person. So, for example, there is three persons. So, these three persons are related. For example, these three persons are cousins. So, the first person owns a 20% share in the company, ABC company. So, the other person is also 20%, and person C is also 20%. So, if we will combine their share, the total is 60%, and we can consider them also as a related party. So, they need to follow the arm's length principle. Okay, so there is another case for two or more juridical persons where alone or together with its related parties directly or indirectly owns a 50% share or a greater ownership interest in other juridical person. So for example, there's ABC company owns a 50% shares in DEF company. So this since the ABC owns a 50% to the DEF company, so we will consider them as the related parties. So in another scenario, one juridical person alone or together with its related parties directly or indirectly controls the other juridical person. So for example, so ABC company owns a 20% shares in DAF company, and this person A owns the 40% shares in DAF company. This person A is a related party of ABC company. So their total shares is 60%. So we can consider them also as a related party. So in another scenario, any person alone or together with its related parties directly or indirectly owns 50% or greater ownership interest in control such two or more juridical person. So for the example, person A 50% for DF company, and he owns also the 50% ABC company. Although the ABC company and DF company are not holding any share in each other, but they will be related because the person A holding 50% shares in the both companies. So there's another one, a person in its permanent establishment or foreign permanent establishment. So person. So when we refer about the permanent establishment, we are referring to a person who has a company in UAE, but he's not a UAE resident. So for foreign permanent establishment, UAE is a resident who has a company outside UAE. So we will consider them also as a related parties. So there's another two or more persons that are partners in the same unincorporated partnership, and a person who is trustee, founder, settler, or beneficiary trust or foundation in its related parties. So when we say the person who is trustee, founder, settler, or beneficiary, so it means they are exercising 50% more of the voting rights. So he has the ability to appoint most directors of the other person, and he has the ability to significantly influence the conduct of the business. So now we will move on for the payments to connected person. So a payment or a benefit provided by a taxable person to its connected person shall be deductible only if and to the extent the payment or benefit corresponds with the market value of the services. So we shall consider a connected person or a taxable person if that person is number one, an owner of the taxable person. An owner of the taxable person is any natural person who directly or indirectly owns an ownership interest in the taxable person or controls such taxable person. So number two, a director or officer of the taxable person, where the taxable person is a partner in an unincorporated partnership. A connected person is any other partner in that same unincorporated partnership, and any person that is related party of the partner. So for the last one, a related party or any of the persons referred in the paragraph. So to determine that a payment or benefit provided by the taxable person corresponds with the market value of the service or otherwise provided by the connected person. So we're giving this examples so that we can understand better. So for example, this one, an ABC company is selling goods in DAF company. So the ABC company is giving the price of 120 AED per ton for this DAF company, while the other scenario is ABC company is selling the goods in third party, which is 150 AED per ton. So as per the transfer pricing rules, they need to maintain the market value. So it should be the sale should they should adjust the payment. They need to maintain the arm's length price. So for this article shall not apply any of the following. So number one, a taxable person whose shares are traded on recognized stock exchange, and a taxable person that is subject to the regulatory oversight of a competent authority in the state. Any other person as may be determined in a decision issued by the cabinet at the suggestion of the minister. Now we will talk about the arm's length principle. So what is the arm's length principle? So it is a transaction or arrangement between related parties meets the arm's length standard. The result of the transaction or arrangement are consistent with the result that would have been realized if persons who were not related parties had engaged in a similar transaction or arrangement under similar circumstances. So these are the list of acceptable transfer pricing method that can be used to determine the arm's length principle. So number one, the comparable uncontrolled price method, and then the resale price method, the cost plus method, the transactional net margin method, and the transaction profit split method. So the order of the methods listed does not indicate nor imply a hierarchy method that should be used. The choice and application of a transfer pricing method or combination of transfer pricing methods under this article must be having regard to the most reliable transfer pricing method and not taking into account of the following factors. So number one, the contractual terms of the transaction or arrangement, the characteristic of the transaction or arrangement, the economic circumstances in which transaction or arrangement is conducted, the function, performed, asset employed, and risk assumed by the related parties entering into transaction or arrangement. And the last one will be the business strategies employed by the related parties entering into transaction, or arrangement. So the last part of this webinar is the documentation. So based on the Ministerial Decision Number 97 of 2023, requirements for maintaining transfer pricing documentation for the purpose of Federal Decree Law Number 47 of 2022 on the taxation of corporation and businesses. A taxable person meets either the following conditions shall maintain both local file and master file. So what is the local file or master file? So when we say local file, it should be provide an entity and transaction level transfer pricing analysis for each jurisdiction. It is to field locally with the tax authorities in each jurisdiction, while the master file provide a high-level view of the company businesses, operations, and global transfer pricing policies. So they need to maintain both master file and local file where the taxable person for any time during the relevant tax period is a constituent company of a multinational enterprises group as defined in the Cabinet Decision Number 44 of 2020. It's referred to the above that has total consolidated group revenue of 3,150,000,000 United Arab Emirates. So that's it for our discussions. If you have any questions or any comments, you can put in our chat box. For all the questions, we will answer it one by one.